Can you be an employee of your own LLC? This question is crucial for many business owners looking to compensate themselves for their work. The answer isn't always straightforward, but understanding the rules and options can help you make the best decision for your business and personal finances. Generally, LLC members are not considered employees of their own company. Instead, they're classified as self-employed individuals for tax purposes. This means they're subject to self-employment taxes, covering both Social Security and Medicare contributions. However, there are exceptions and alternatives to consider. The way you can pay yourself from your LLC depends largely on how your business is structured for tax purposes. If your LLC is taxed as a partnership or sole proprietorship, you can't be an employee on the payroll. Instead, you can pay yourself through distributions from the business income. While this method is straightforward, it's important to note that these payments are not tax-deductible for the business. For LLCs taxed as corporations, the rules change. If your LLC elects to be taxed as an S corporation or C corporation, you can become an employee and receive a salary. This approach allows for more tax planning opportunities, but it also comes with additional responsibilities and scrutiny from the IRS. When it comes to payment options, LLC owners have several choices. These include owner's draws, guaranteed payments, salaried compensation, and even independent contractor arrangements. Each method has its own tax implications and benefits. Owner's draws are simple withdrawals of profits from the LLC. They're common for single-member LLCs and partnerships. However, taxes aren't withheld from these payments, so you'll need to make estimated tax payments throughout the year. Guaranteed payments are fixed amounts paid to LLC members, regardless of the company's profit levels. These are treated as business expenses and can reduce the LLC's taxable income. If your LLC is taxed as a corporation, you can receive a regular salary as a W-2 employee. This simplifies tax compliance but requires adhering to payroll tax regulations. It's crucial to ensure that your salary is reasonable for your role and industry to avoid IRS scrutiny. Some LLC members choose to contract with their own companies as independent contractors for specific services. This requires issuing a 1099 MISC form and may limit certain benefits. When deciding how to pay yourself, consider the tax implications carefully. For LLCs taxed as partnerships or sole proprietorships, you'll pay self-employment tax on the total amount of the business profit, which is about 15% of the net profit. Making regular estimated tax payments can help avoid a large tax bill at year-end. For LLCs taxed as S corporations, you can potentially reduce your tax burden by taking a combination of salary and distributions. While your salary is subject to payroll taxes, distributions are not. However, your salary must be reasonable for your role to withstand IRS scrutiny. C corporations allow for more traditional employment arrangements, but they face double taxation on corporate profits and individual wages. It's also worth noting that married couples who own an LLC together have additional considerations. In some cases, it may be beneficial to employ a spouse and pay them a salary, which can be deducted from the business's profit before taxes. In conclusion, while LLC members generally can't be employees of their own company, there are various ways to structure your compensation. The best method depends on your LLC's tax classification, your personal financial needs, and your long-term business goals. Given the complexity of these decisions and their significant tax implications, it's always advisable to consult with a qualified tax professional or attorney to determine the best approach for your specific situation.